Hey there, this is Ike Hoffman with Tactica Real Estate Solutions, and we're going to go through our fix and flip versus fix and hold analysis. This is part of our residential analysis template that allows you to analyze a property that's single family home up to 4 units and has either potential to be a turnkey investment, meaning you're buying it, it's in pretty good shape, you can rent it right away, maybe you're inheriting renters, or you need to do a rehab and you either want to do that rehab and sell it right away, so a fix and flip, or you want to fix it up and hold it for the medium term. I have another video that's going to cover the turnkey analysis. This video specifically pertains to fixing it up and evaluating whether it's a better deal to just fix it and sell it quickly or to hold it. There are a couple workbook rules you can see off to the right here. I ask that you do not add or delete any rows anywhere in the workbook. Don't delete any columns either. And then please don't delete any worksheets. You're more than welcome to add worksheets. So if you open up this analysis and you have some other components that you want to factor in that maybe this workbook doesn't, you can add as much as you want into this workbook. I just ask that you don't delete anything. And there's a reason. I use macros to improve your user experience. So for example, you can see right here in this strategy cell, we're currently looking at a fix and hold analysis. What's cool about this model is if I click turnkey, you'll notice the entire investment dashboard transforms. Now, what's actually going on is a bunch of rows are hiding themselves or reappearing depending on what the argument is in this cell. So if you're deleting things, it might throw off the macro that makes the user experience super intuitive, and I want to avoid that. So I'm going to put this back to fix and hold. Whether you click fix and hold here or fix and flip, it's going to be the exact same. The reason why I have different arguments is just so if you're showing this to investors or an investment partner, it's clear what your strategy is, or at least your preferred strategy going into the pro forma analysis. So I'm going to go ahead and I'm going to click fix and hold again. See that the dashboard transforms quite significantly. And then let's go through each one of these blocks of information. So in the up corner, this is where you're going to enter in some acquisition assumptions. The brown text cells are your responsibility. Black text, it's either going to be a formula or a label, like over to the left here. So you're going to need to enter in the price, whether you're buying it from the property from a wholesaler or on the market or off market. This is where you put your price argument, and then closing costs you'd enter in the bottom left-hand corner. This would not include financing costs. That's in a different section that we'll get to shortly. So you can see here there is some unique formatting here where you would just need to enter in 3% or 4%, whatever, and then the cell will calculate 4% as a percentage of the purchase price, and then closing costs is automatically formatted in there. The Capex budget and the cost of the loan, those are populating from other places. We're going to get into all that. In the middle here, this is your general property information. So where you'll type in the address, how many units it is. So from 1 to 4 units are your options. The square footage, and then you can put in when you plan on closing on the property as well. As we've already discussed, you'd select your strategy in this cell, F11. And then there's some cash management. So to be perfectly transparent, I am in no ways a residential investor. I scoured the web and got feedback from people that are actively in this space. And my understanding is, obviously you're going to need cash to close the deal, but if you're doing a fairly extensive renovation and you're using, a construction loan product or hard money, they typically will require you to front those costs. So if you need to redo the roof for 30 grand, you would pay 30 grand out of your own pocket. The lender would send an inspector out to the property and then reimburse you. So this cash needed after close, we're going to get into the draw schedule and all that, but this is just basically telling you, hey, yes, you need 55 grand to close the deal, which we can see is presented in the equity needed. But your first couple of repair items are going to cost 22 grand or just under 23 grand. You need to pay that out of your own pocket or with a credit card or on a revolving credit facility, whatever your preferred method is, and then you would get reimbursed by the lender. And then there's a grid of the cash outflows as well. So this is all flowing from the Capex tab down here, which we'll get into next. But you can see you'd essentially be doing draws every other month in order to fund the renovation taking place at the property. And then we get into the construction financing. I give you a couple different options here. You can do a loan that's either based on loan to cost. So the cost would be the cost of the property plus all the renovations. You can do your loan as a percentage of ARV, which you would stipulate what the property would be worth post renovation in cell C15 here. Or you can just do it the traditional way, LTV. So this would be, if you put an LTV, it would be 85% of the $205,000 purchase price. So you have a couple different options. I'm going to leave it at loan to cost for now. You would enter in then the percentage, whether it's 85% I have in right now. I'll change that to 80% just to be a little more conservative. You type in the interest rate, the terms and months, the construction loan or the hard money. We're assuming that it's short-term debt. So enter the term in months. It's going to automatically assume that the loan during the construction is interest only. So you don't need to worry about doing anything there. And then interest accrual is also an important assumption. You have two different options. You can do standard or pre-drawn. I've heard of some financing arrangements, even though you're not drawing on funds to repair the property, maybe until the fourth or fifth month, the funds that the lender is willing to give you will start accruing interest from day one. You could select pre-drawn here, and I'll show you how this works later, but essentially, if you select pre-drawn, that interest accrual begins on 100% of the funds they're going to give you starting day one. And then loan cost as well. This is a percentage of the total loan amount, and that's what's flowing in to cost of loan in cell C7 in your acquisition assumptions. In the middle section here, these are your refinancing assumptions. So the model, to look at a fix and hold scenario, assumes you're going to blow out your construction loan or your hard money and put on hopefully either bank or agency financing. So you come up with a LTV percentage, an interest rate, a term, this time in years, your amortization, loan cost, and whether or not there's interest only. If you do select that there's interest only, you'll get another argument where you have to enter in how many months of interest only you would receive from the lender. Refi populate off to the right. So the model will summarize firstly when the refi takes place. Notice these are all black cells, so they're populating from other places. It'll show you how much refi proceeds you're getting back, what percentage of equity is returned, cash still in the deal, some debt covered stuff, and cash on cash returns post refinance. I'm going to wait to talk about comparing a fix and flip versus a fix and hold. I think it's going to be more intuitive if we get more into the weeds of the model and then come back and revisit. You have sources and uses summarized in the bottom left-hand corner. You have residual assumptions as well. So this is for if you continue to hold the investment. If you're doing a fix and flip, the model assumes you're going to get the ARV when you go sell it one day. If you do a fix and hold, the model will essentially take your ARV at the end of year one when the renovation is completed, and then it's going to tack on an annual appreciation assumption of 1%. So you can do 1%, 2%. I'm being really conservative and just going 1% over the ARV. You can see then, I currently have a 10-year hold in the model. So the model assumes that when you go sell this property, you renovate it at the end of year one, it's worth $325. And then when you sell it in 10 years, you'd get $355 for it. So there's some other metrics here related to this appreciation. Just make sure you're being responsible with this assumption. As you probably know, if you're aggressive with the appreciation, it's the easiest way to make a deal look good. And then you also have a cost of sale argument as well. So I have 6.5%. So when you go sell this 10 years from now, you'd essentially pay 6.5% of the residual sales value and things like closing costs, legal fees, paying a realtor, those types of items. And then the final visual on this dashboard is just a summary of cash flow. It's obviously going to be a little goofy in year one when you're doing the renovations, but then your NOI, your cash flow after debt, and your DSCR will be summarized for each year that you hold the investment. So now let's get into the meat and potatoes of the model and start with the Capex plan. The Capex plan is really powerful because it lets you input all of the budget capital items in columns B and C here. But what's cool about it is you can also control when you'll actually be needing the money for these repairs. So you can see windows. I'm assuming those are getting taken care of right away. You're going to put in windows month one and you're going to finish it that same month. So the $2,000 allocated for windows, it's going to all be a cash outflow during that first month. Whereas you can see bathrooms, I'm having that expense, the $10,000 expense, start in month 2 and end in month 3. So it's $10,000 total, but it's going to be split up with two $5,000 expenses in months 2 and 3. If you're doing a fix and flip, you control when the sale month is. Optimally, you'd finish your renovation and you'd sell it the next month. But if you do want to be more conservative, you can play with this assumption. So maybe, you want to give yourself some leeway, and it's maybe the market gets soft during your renovation and you think it's going to take you 6 months to sell it. Well, you could set your sale month to month 12, and then that's going to affect your returns in the pro forma because you're going to be paying more interest, right? Until you sell the property, you're not going to be able to pay off the construction loan or the hard money loan. And you're just getting that big influx of sale proceeds later in the pro forma. So this will impact returns, and we can come back and show you how this affects the IRR, which is a time-sensitive metric. I'm going to put that back at 7. The model assumes that the renovation will be done within a year. This is like a 1 to 4 unit property. If you're doing a more extensive renovation and it's super detailed, or you're doing more units, I suggest you look into my multifamily value add model. But it just makes things a lot simpler and it presents a lot better if the construction duration is under 1 year. Most feedback I've received is that the average construction period of a rental property, single family home up to 4 units usually takes around 6 months. And then for the fix and hold analysis, the model will assume that if you're leasing up the property, if this is a rental and you want to get renters, this particular example that we're looking at now is a duplex, it assumes that it would happen 1 month after the sale month. If you're selling this asset, it would be ready to be rented anyways. So the model's just going to take the 7, add 1 to it, and assume that if you're going to charge rents, those would begin flowing in. The cash flow benefit would begin flowing in month 8. And then the refinance would happen as well. Agency or bank financing, they're going to want to see proof of rental income. So that's all going to be happening at the same time, 1 month after. So you can see if we change this, the flip and sale month to 8, and then the fix and hold assumptions won't start until month 9. So they're always 1 month after the fix and flip sale month. Get back to 7. This budget here, you can see what the total capital spend is monthly. You can see the allocation, or what percentage of the total capital is being spent each month in row 24 here. And then you also control construction draws. Usually construction draws cost money. I've seen anywhere from $200 to $500 is common. So I have 250 plugged in there. No, that's a brown cell, so you'll be needing to adjust that. I have draws every other month. If maybe you're a little more cash strapped, you'd be more comfortable doing them each month. You have a lot of flexibility. You either leave it blank or you put in a 1. The model will then calculate the interest and the cost of the draw automatically for you. You can see how interest starts to build up as you're drawing more funds over the months. We talked earlier about that pre-drawn or standard interest. Some hard money lenders will begin the accrual on all funds, even though they're not drawn yet. So if you did want to do that, just pay attention here. Notice it starts at 706 and it jumps to 933. If you go to the investment summary and you click pre-drawn, your interest is maxed out every month until you eventually sell it or refinance. Total interest and draw costs are summarized below. You can see the total cash outflows. This is just a total of the cost of the draw, the interest, and the funds drawn. And then you can see the draws as well, which are balancing them out. I know there's a lot of strategy with draws and just being able to maximize your cash. I've read on various articles that the common rule of thumb is to figure out, have more of your bigger costs on the front end, and front that yourself, because then you'll eventually get reimbursed for a larger cost. As long as no future renovations cost more than that, you'll be able to continually reinvest that initial chunk of money that you put into the deal, and you won't have to dip into your pockets any deeper than you did on that first draw. So that's what's cool about this particular budget tab, is you can enter in all your expenses up here, and you can really play with the numbers and make sure that you're absolutely maximizing your draw schedule and doing things in a way that makes the most sense from a financial perspective, and that's hopefully going to overall minimize your financing costs. This pink row down here, total cash needed. When I have the first draw happening in the second month, you'd essentially need to front $23,000 out of your own pocket before you get reimbursed by the lender. That's what this row here in 36 is telling you. And then there's also a row telling you how much interest is charged after the last draw. Just so you're aware, okay, the renovations are done, but you're still paying interest. So if it takes a while to sell the property, let's say it takes 10 a month, won't sell till month 10, you can see that the total interest after the last draw, it ticks up significantly. So that's just another thing to keep an eye on. The operating summary serves a couple purposes. It's where you're going to be entering in the operating holding costs. So when you're renovating the property, you're still going to be paying utilities, you're going to be paying insurance, property tax, and then this is where you're also going to enter in your stabilized assumptions. The reason why I combined the fix and flip and fix and hold is because it literally takes just a couple extra seconds to enter in some stabilized assumptions and see how the numbers would play out over a 5-year or a 7-year or a 10-year hold. Up here, you can see that these months will calculate automatically. The pre-stabilized months are when you're renovating the property. That was determined on the Capex plan when you typed in a 7 here. Go back to the operating. In month 8, the property, you're going to lease it up. It's going to be stabilized, but you're not going to have your first full stabilized month until year 2, months 13 to 24. And then after year 2, you're going to enter in just some baseline escalator assumptions. So you can see I'm just doing 3% increases on all revenue and expense items for the duration of the pro forma. The first thing you need to do is come to this pre-stabilized section and enter in all your holding costs. Then you'll come in and enter in the rents. What do you think you can get for rent? So right now you can see it's a duplex. There are some rows hidden here. If this was like a fourplex, for example, you just come in here, unhide, and you could enter in all that pertinent information as well. So I'm thinking $1,300 and $1,200 for rents, and then I'm pretending that there's a garage, and the garage space can be charged for $50 a month. You can make all of your assumptions on a monthly or annual basis. And then once you're fully stabilized, you can do it on a monthly basis, annual basis, or it's just a percentage increase over the previous year. So once we get in year 2, I'm just doing a 3% increase over $1,300 a month in rent, and doing the same thing for the other unit, which is only rented at $1,200. And again, the same thing for the parking, the $50 a month in parking revenue. Expenses are pretty much the same. You're making your expenses either on a monthly or annual basis. You can see how some of the expenses are changing once the property becomes stabilized. For example, like heat and gas was something that technically I would be paying during the rehab, but once there's tenants in there, they'd be taking that over. So I would just leave that blank here. Water, sewer, and trash would go up when there's people living in the properties. They're going to be flushing toilets, taking showers, doing those types of things. So that expense you'd expect to increase. They would handle their own electricity, those. You might have to pay $30 a month or $20 a month for like a common area, but that should decrease significantly. And then repairs. There's still, even though you renovated the property, there's going to be recurring monthly maintenance items you need to take care of. You'll notice during the construction period, there's no repairs, right? Because all that repair money would be tied up in the Capex that we detailed in the Capex Plan tab. The big thing for expenses for this particular property is real estate taxes is likely going to jump significantly because the property was renovated and is in a lot nicer state than it was before. So I have the property taxes jumping from $2,850 all the way up to $3,800. And then I'm growing all the other expenses at 3% annually. Now you can see the management fee. If you're going to self-manage it, you just put in 0% here. All the text is black for the actual assumptions. That means you don't need to do anything with it. It calculates automatically for you. You just type in whatever percentage of management fee you want, which then is multiplied by the total revenue to come up with your management fee. Economic loss, this would be your vacancy, your concessions. Obviously, you're not going to have any vacancy while you're rehabbing the property. Once it becomes stabilized, then I'm doing 5% just for the duration of the pro forma. Your stabilized assumptions are summarized nicely in this middle section here. You can see the monthly stabilized assumptions, the annual stabilized assumptions, the expense ratio, and then to the far right, you're able to see the 10-year cash flow projection. Most importantly, you can see how your NOI ramps up. First, you're pre-stabilized in year 1. You only get 5 months of rental income. And then it jumps all the way up to $18,000, and then you're seeing pretty much 3% increases every year. This is a great page to print to show investors or partners come here, print, it's ready to go. You have all your assumptions summarized, your stabilized operations, and then on the second page, the 10-year cash flows will be nicely presented as well. All right, so now we get a little more into the weeds on actually what's happening with the fix and flip. So the next tab, nothing you need to do here. Everything is just flowing through nicely into this fix and flip pro forma. These are your operating expenses that you would need to pay out of pocket during the flip. These were your utilities. These were the property taxes, the insurance. So this pro forma, the fix and flip, is monthly. So the analysis starts on 10/1/2020. That's what was typed in on the project closing. And you can see, we already specified that this renovation is going to take 6 months. The sale would happen in month 7. You can see all the rehab costs. They're reimbursed with the loan draws from the construction loan or the hard money lender. All the draw fees are summarized, and then the interest expense is summarized as well. I'm actually going to turn interest expense back to standard. Forgot to do that earlier. Okay, so now we can see that it ticks up nicely instead of just starting at 933 in month 1. You can see the acquisition, the escrow and closing costs, the financing costs, the loan payoff. So initially, you're going to get $154,100 from the lender to close the deal, and then you're drawing on that loan. So the loan pay down is increasing every month by what you're spending on the rehab, and then you eventually pay down the total loan of $203,600. So just to verify, $203,600 gets paid down. You go back to the investment summary tab. The total loan amount was $203,600. It matches out. And then all the returns are summarized. So you have a levered IRR, a levered equity multiple, a levered profit. And then I always like to compare the return metrics to how it would look if you purchased the deal in cash. Now, understand, if you're using this model, there's a very small chance that you're ever going to fund a fix and flip or a fix and hold in 100% in your own cash. But I think it's crucial to do to make sure that your profit is accretive. Make sure that you're getting a lot of extra boost from the leverage and risk you're taking on by taking out debt on the property. So I always compare the two. Just a personal preference. If for whatever reason you didn't want to see all cash returns, you could just hide the row. And then all of the cash flows are stored below. So if you wanted to see actually how the levered IRR and the all cash IRR are being calculated, you can just open up this little check mark to the left and see the cash outflows and eventual profit upon sale in this hidden section. I'm going to hide that again. And then we go to the fix and hold summary. The fix and hold scenario is an annual pro forma. So we have the effective gross income. You can see how it's not fully stabilized in year 1. It jumps from 12 then to up to almost 30 grand in year 2. You can see that same thing happens with operating expenses. You can see the rehab, the total rehab was $49,500. We can just verify that quick. $49,500 in total capital. That checks out. It was reimbursed by the lender, the draw fees, the interest expense, and then the permanent financing will start up. Remember, we put in the permanent financing assumptions here. So in year 1, you can see that the total principal and interest is well below what's being paid in year 2, and that's because in year 1 we refinanced technically in month 8. So this is only 5 months worth of payments of principal and interest to the lender. That's why it's so much. You can see the total here. What's highlighted, $6,021, where in year 2 it jumps all the way up to $14,449. Again, that's just because year 1 wasn't stabilized. There's only 5 months that we were paying debt service on the permanent financing. There's a refi section. Again, in the investment summary, you came up with an LTV assumption. So basically, you would be getting 80% of the as repaired value. That's flowing in is this $260,000. You'd pay off the hard money loan balance. You'd pay some financing costs to get the permanent debt. And then your total refinancing proceeds would be $53,800. And then the final section relates to residual sale proceeds. The ARV we set at 325. We set a 1% annual increase in property value year over year, so that's tracking here. The cost of sale, we set it at 6.5%. Both those assumptions were made in this bottom middle section on the investment summary tab. And then the debt is being tracked as well. So as you're paying more principal down, the loan balance goes down and you'll get more residual sale proceeds the longer you hold the property. And finally, all of the cash flows are summarized. Again, I have all cash IRR, levered IRR, all cash equity multiples, and then your cash on cash returns, both all cash and with the leverage. So you can see the cash on cash returns are very attractive in this scenario. And that's because a good portion of your initial equity investment was already paid back to you when you refinanced, which reduced your investment basis, which is the denominator of the cash on cash formula. If you want to see the details of how this stuff's being calculated, you can see what your all cash and levered cash basis is. And it's just taking the cash flow and dividing by these amounts. If it's not clear, the model's smart from the standpoint, it's looking at what your returns would be depending on what year you decide to sell. So if you sold in year 3, you'd have a 33% IRR, versus if you sold in year 10, you'd have a 24.48% leveraged IRR. So it's really up to you to figure out, would you rather have more of a slam dunk return and make your money faster and have that higher IRR? Or would you like to hold it longer and maybe have a more modest IRR, but it's over a longer term? Those are the kind of decisions you need to be making as an investor, trying to figure out whether you should be recycling your capital into other projects or leaving it in to strong performing ones that you may not be able to find something better in the open market. These are the IRRs if you sold in year 1. The model knows that you wouldn't refinance and then sell that same year. So if you sell in year 1, the all cash IRR is about 28%, the levered IRR is 60%. If you go to fix and flip summary, it's the exact same. So it's literally just pulling from there. So when you're looking at the year 1 sales metrics, this is just assuming that you're essentially doing a fix and flip. And then the final tab is the refinance debt. This is just storing the amortization for the permanent debt and really tracking the principal, interest payment, and loan balance that flows into the pro forma for the fix and hold tab. So that's where all of this information is actually being stored. So if you go back to the investment summary, this was the last part I wanted to talk about. You can compare the return metrics between a fix and flip and a fix and hold. You can see the first column here specifies the hold period. For fix and flip, this is in months, so it's 7 months. And then for fix and hold, you can actually choose the year and it will toggle the returns for you. So maybe we change this to 5 years. Everything will update automatically for you, even with the residual assumptions and the various return metrics. But you can compare the leverage IRR between the two, the equity multiples, the annualized rate of return, and then the total profit. So again, it just goes back to that question. Would you rather make a quick $22,000 by fixing and flipping it and be able to recycle your capital in something better? Or are you the type that would want to renovate it and hold it and see more total profit but lower returns? Right? The IRR factors in the time value of money. So the quicker you can flip this thing and sell it for the ARV of $325,000, the higher that leveraged IRR is going to be. Well, if you fix and hold it, the IRR is still nice. It's almost 30%, but obviously it gets reduced significantly because you're holding it longer, and that time value of money will eat into the return. So this is just a nice area. You might be thinking, I'm a fix and flip. I don't want to do fix and hold, but I figure it literally only takes 1 extra minute max to come into the operating summary and type in your stabilized assumptions. As long as you do that and then type in the escalators you want in the future years, then you'll have an entire fix and hold analysis and you'll be able to compare the two and come up with a solution that aligns with your investment goals. So that wraps up the fix and flip versus fix and hold analysis. If you haven't checked out the turnkey analysis, please do so. You may come across a property one day that it's a good deal. It just spits out cash flow and you don't need to sink a whole lot of money into it. It's not a lot of work. You can just buy it and start cash flowing day one. That video will talk to you about how this model handles that analysis. I hope you enjoyed the video. If you have any questions about either fix and flip, fix and hold, or the turnkey analysis, don't hesitate to send me an email. I love improving these tools and hearing your feedback. Appreciate you taking time to watch the video, and hopefully we get in contact soon. Take care.